seen a number of countries enter the dollar market over the recent years. The most recent example is, of course, Zambia, which had an extremely successful placement that took place just a few months ago, and that trend is expected to continue. When you look at it from a local markets perspective, what we've seen over the last 5 years is that foreign investors have become very interested in trading the domestic debt. It's still heavily concentrated in the treasury bill market, but certainly African markets have welcomed foreign investors by and large to come in, and we've seen a huge amount of interest, whether it be Uganda a year ago, Nigeria at the moment, Ghana from time to time. All these markets are opened up and are active foreign participation in them.
Two significant results we need to chat about is obviously Nigeria's government bond being included in the JP Morgan government bond index, and then of course the South African government bond being included in Citi's world government bond index. Game changers for the African continent, in your opinion?
Well, certainly, because particularly the Nigerian example, it shows you, the work that a debt management office can do and delivers results. Here, they've changed the way in which they issue. They've created liquid domestic markets. They've created benchmark size issues, and something which not only the local markets are able to trade in and out of, and even short when they want to, but it's also opened it up for foreign investors to come in, and that to me is probably more significant in many respects than South Africa going into the World Government Bond Index, because South Africa has had a developed domestic market for a very, very long time, and in many respects, this could have happened at any time in the recent history. Whereas for Nigeria, it's actually taking it a step up. It's taking it into, it shows you the Nigerian bond market as little as 2-3 years ago, 4 years ago, post their banking crisis, it was a dead market. It stopped trading and has gone from that to a market which is now in a very popular international index to track.
The ratings downgrades that we've seen on the South African front, do we need to be concerned?
Well, we need to be concerned. And it's not necessarily just about Europe spoiling our party, but we're doing quite a good effort of spoiling our own party. And there specifically, the mining crisis comes to the fore in terms of here we have very specific issues, but going outside of legal frameworks and creating huge disruption on, possibly on our GDP, certainly on our trade flows, very certainly in the labour relations process, and is spilling over into sentiment into other spheres as well. To some extent, though, the stage had been set by Europe, where we've seen our growth forecast being revised down, and that is something which is probably just a little bit, beyond our control. And I think the National Treasury has been, admirable in its response. First, allowing the purse strings to loosen, and two, now talking the book where they feel they need to. They've reached the debt levels or approaching the debt levels, and they now need to start contracting on the fiscal expansion. Now, of course, the budget this week will be very telling in that sense, because part of the reasons for the downgrades was the belief that there will be further fiscal slippage, and now it's Minister Gordon's opportunity to stand up and say he can do this, and he can.
Do you believe he can do it?
I think he can. I mean, it is the first time that he's been truly tested in a difficult environment. I mean, it was fine to say we're going to loosen the purse strings when things got tough, but now things are still tough, and now he's got to start pulling in on the purse strings. So it's going to be a very, very difficult budget for him. But I think the Treasury's got a very solid track record in knowing what needs to be done. He's got a solid team backing him up. So I believe that they will pull through, and they will come up with some tightening of policy.
I picked up a quote recently from the World Bank, and it goes something like this: the Africa train has left the station. If you aren't on it, you stand the risk of becoming irrelevant. Your comments?
Well, certainly, I wouldn't quite say it's necessarily left the station, but it is a train that is starting to move. And we've heard remarks earlier today about concerns about, bubbles building and things like that. There's cyclical components to it. I certainly think it is a market which people need to be aware of, both not just from a portfolio flow point of view, but certainly from an M&A and agriculture point of view. All these spheres of investment are absolute at the forefront. I mean, in the portfolio flow environment, it can be a little bit cyclical, and certainly in some markets it does look a little bit too tight at the moment. Other markets are more attractive. Like Nigeria might be a little bit tight, but Ghana is probably a little bit more attractive. But certainly from other aspects, there's a lot going on in Africa.
And just one final question: the domestic bond environment. There's now a sense of urgency with the developed world still in a beleaguered state that we really need to fast track the domestic bond environments on the African continent. Are we going to achieve that? Can we accomplish it in the near term?
Well, it can be accomplished, certainly. And there's a few very basic things which the debt management officers need to achieve. And one of them is retapping issues and building a very solid debt management framework in which they can then ultimately manage the maturities of these debts. Because, of course, it's a big challenge. Like South Africa's facing that at the moment. How do you manage these large redemptions which come through? But, these are relatively simple steps and a very easy starting point to say, let's just get liquid issues out there, and that will make the market tradable.